Hello everyone, very good evening and welcome back to Crack Grade B. So today we are going to talk about risk management in banking, basically focusing on what type of risks are there in the banking sector, what kind of risks you can see, and then we'll be also be talking about the Basel norms of risk management in your banking sector, which have been mandated. So let's start. See, what is risk? First, understand that particular thing, then we'll move on to the other requirements. See, risk means you already understand. Whenever we are going to talk about risk, there are two things which we should be talking about. One is risk and the other one is return. Risk and return. And let me tell you that there is a direct relationship which exists between both of them. Direct relationship means if return is increasing, then my risk will also increase, and if the return is decreasing, then obviously my risk will also reduce. Now let me give you an example for this. For example, your government securities. If I am an investor and I am investing in government securities, then on an average basis, the return which is offered by government securities is lesser than the market rate of returns of other securities. Suppose, for example, this is for your example that government securities are giving me 4% interest. They are giving me 4% interest versus there is a company ABC Limited. If I am going to invest in this particular company, they are offering me a return of 6%. Clearly, the returns are less in case of government securities, right? But at the same time, risk is also less. And here, if the returns are more, obviously in comparison to government securities, my risk is also more. So this is the relationship between risk as well as return. That is what we are going to study in this chapter, that what all are the risk types which exist in case of banking sector. So I hope now you understand the relationship between risk and return. If in any scenario your risk is more, then your returns will also be more, and vice versa the situation. See, risk takes on many forms but is broadly categorized as a chance wherein outcome or investment's actual return will differ from the expected outcome or return. Suppose you have expected that you are going to earn at least 20,000 rupees in form of dividend. This was your expectation, but in reality, due to market circumstances, you only got 10,000. Now this is your expectation, this is your reality, and the difference between expectation and reality is the risk that is you people take or the banking sector takes. Now risk includes the possibility of losing income, losing original investment. Different versions of risk are usually measured by calculating the standard deviation of historical returns or average returns. A fundamental idea in finance is the relationship between risk and return, and risk is directly proportional to the return. Always remember this, that what is the relationship between risk and return? Both are directly related to the each other. If one is going to increase, then other is also going to automatically increase. I have talked about, whenever I have talked about investment, I have told you that there is a credit rating which happens. Credit rating happens for companies, as well as credit rating also happens for your governments as well. Like as an Indian government, we have got a credit rating that is called as sovereign credit rating. So if a company has been listed as the least favorable company to invest in, now because of this particular low credit rating, the if this company wants to take any kind of loan, it will become very tough. Why? Because investors are not attracted. So if you have got risk in your company, then the returns which you will have to offer has to be increased. Now take it this in this way. Suppose there is a person, right? That person has got the reputation of not repaying the dues on time. That means he has got very low credit rating. Now because of his this low credit rating, if in future he wants any loan from someone, then he has to say that I will pay you a good interest rate. Until and unless he will not offer a good amount of return, nobody would like to invest in him. So this is the case. This is how your risk and returns goes hand in hand. So risk refers to an undesirable or unplanned event which is concerning the finance that can result in loss of investment or reduced earning. It includes possibility of losing some of the entire amount of investment. Bank take a risk because of the fundamental relationship between risk and return. There is a direct relationship between risk and return, hence the greater the risk, higher the chances of profit. But it is not always the case, hence the risk that banks take need to be managed well. Obviously, suppose you have invested in a particular company, that company was a risky one, but still you invested in it because returns were too high. Now, once you invested, that company went bankrupt. Now, what will happen? You have taken the risk, you have got no return. So, there are possibilities both ways. Whenever you are going to take a risk, your track can go in a positive way as well, your track can go in the negative way as well. So both the chances are there. Now this is it. Now we will be talking about few of the basics about banks, because these basics, I don't know, many of you will be knowing this. Not many of you, everyone will be knowing about it, but we are going to talk about it in a certain way so that the things which I am going to teach further will be easier for you to understand. Now I'll be asking you few questions and it will be appreciated if you'll answer them, right? So be ready for giving the answers. So this is your bank. You can imagine any bank, in whatever bank you are having your account. These are the assets and here will be my liabilities. This is kind of a balance sheet which I am making for bank. Now my question to you guys is, we all know that what is a bank's function. The primary function of any bank is accept deposits from customer. We go to the bank and we give our money and deposit it into savings or current or fixed deposit, right? So these kind of deposits we give to the bank. So bank's primary work is to take deposit from the customer and keeping a certain portion with itself in form of cash reserve ratio, statutory liquidity ratio, and transferring the remaining part to the borrowers. Means whosoever wants the loan from the bank give loan out of that, right? Understood? Now tell me, in which side, whether in liability side or in asset side, in which side I should be writing loans given? The loans which have been given by me, I should be writing in which side? In asset side or liability side? Very good. So the loans which have been provided by me are bank's assets. I hope this point is clear to everyone because this is very crucial thing. Sometimes we tend to get confused in this. So any kind of loan given is your asset. Now what else I should be writing in the asset side of the bank? Tell me that. What else I should be writing in the asset side of the bank? What is the other thing which I should be writing in the asset side? See, the other thing you can write is investments made, right? You must have heard about that banks have to purchase government securities, gold and other things in order to fulfill the requirements of statutory liquidity ratio or the cash reserve ratio. Yes, good. So as a bank, I would have made some investments. These investments could be in form of shares, bonds, debentures, etc., etc. Right? These are my assets. I am going very basic. Now, in case of liabilities, what should I be writing first? What should be my first liability over here? In case of liabilities, what should be my first item as a liability? Capital. Every business, whatever kind of business it may be, it needs a capital, right? So capital is one thing because when we'll be reading Basel norms, that particular time this capital will be required. So capital is the one thing. Then time and demand deposits. Any kind of deposits which the bank has taken is obviously a liability on them, right? If as a bank you have issued certificate of deposits and all of these, then these are all what? These are your liabilities because in future you have to repay them. Now once we are clear with this particular scenario, please remember this. We are not going to talk about this again and again. Loans as a bank you have given, those are your assets, correct? Investments which you have made, these are your assets. Capital is the liability which you owe to the owner or whosoever has invested. Next, time and demand deposits, these are your liabilities. Moving on, now let's talk about the type of risks which are there in the banking sector. See, banking sector has been associated with many types of risk, but first let's talk about the liquidity risk. What is liquidity risk? Will anyone would like to explain to me what is liquidity risk or with any kind of example? A year or two back, year back or 2 year back, there was a situation which happened in the Punjab and Maharashtra Cooperative Bank. RBI at that time imposed a limit on the depositors that they can withdraw only a specific amount. They cannot withdraw their total deposit. Suppose if I have deposited 1 lakh rupees in that particular bank, then I could have withdrawn just 20,000 at a particular time. So such kind of crisis appears. Now what about these crises and why do they appear is, liquidity risk means this particular risk means you are not having enough funds in order to fulfill your commitments. So this is called as liquidity risk, because please understand, in form of deposits I have received 100 rupees, right? I have received 100 rupees in form of deposits. Now I have provided loans worth 70 rupees. Means this particular deposit is my base. And when I have given this loan, obviously when I have given this particular loan, the person who has borrowed it, he is not going to spend the total amount in one go. This particular loan will also come in a bank account, right? So this will be available with the bank in form of deposits. The borrower is not going to spend the total amount in one go, right? He will be keeping this 70 rupees in his bank account. So again, bank will use this particular amount in order to give loan. Now, due to this situation, what happens is there can arise a situation when you are not having enough funds in your hand to fulfill your obligations. This is called as liquidity risk. This has been given a separate term called as asset liability mismatch. ALM. If you would have recalled, in the year 2021, 2020 and 2021, we have faced NBFC liquidity crisis. NBFC liquidity crisis that was happening at that particular time. What these particular NBFCs did was, they borrowed. That means they have taken the deposits or they have borrowed in the short term, and they have provided loans in the long term. So you see the timing. Suppose you have taken the deposit for 2 months and you are providing the loan for 2 years. The timing is mismatched. You are taking deposits for a short term and you are giving your loans for a long term. So at a certain moment of time after, you have to repay your deposits, and this is the cause of arising the phenomena of asset liability mismatch. The timings of your asset and your liabilities do not match, and this particular thing causes liquidity risk. Now let's have a look on liquidity risk. See, so liquidity risk is a risk when a bank fails to honor the commitment of payment of deposits to the customers due to inability to meet cash flow obligations. This may be due to rumors like closing of bank or assets turning into NPAs. What is the full form of NPA? What is the full form of NPA? Full form of NPAs, would anyone would like to tell me? Good. Non-performing assets. Now what are my assets? The loans which I have provided. correct? If the loans which I have provided, if they remain due for a period more than 90 days, then they turn into non-performing assets, correct? So if to whomsoever you have given the loan, they are not paying you back, this can also result in a liquidity risk. Apart from them, you have taken the money on short-term basis and you have given the loan on long-term basis. This can also result in liquidity risk. So there are so many ways due to that liquidity risk can arise. Liquidity may be defined as the ability to meet commitments or undertake new transaction. The most obvious form of liquidity risk, inability to honor desired withdrawals. Suppose someone has deposited 1 lakh rupees in your bank. He wants to withdraw 1 lakh rupees. Now, if you are able to honor that, that means there is no liquidity risk. But as soon as you impose a limit that, okay, no one can withdraw more than 20,000 rupees at a time. So this is a sign of liquidity risk. This is a sign that your bank is facing liquidity crisis. You are not able to honor your commitments. Now, next is banking can also be described as a business of maturity transformation. Usually banks lend for a longer period than for which they borrow. Therefore, they generally have a mismatched balance sheet. That's what I have told you. This is called as asset liability mismatch. You are lending, that means your asset is for a longer period of time. You are giving loans for 2-year, 3-year period, but you are borrowing the funds for a shorter period of time, let's say for 6 months. That means your assets have not started paying you, but your borrowers are standing at your door. They want their payment back. So this is a cause of asset liability mismatch, which has ruined the NBFC sector as well in year 2020-2021. Next is liquidity risk in banking is measured by preparing a maturity profile of the asset and liabilities, which enables the management to form a judgment on liquidity mismatch. As the basic problem for the bank is to ascertain whether it will be able to meet maturing obligations or not. Now, based on this particular thing, we divide the liquidity risk into 3 types. First is funding risk. Now, what is this funding risk? Sometimes it happens that due to some rumors, people start withdrawing their amount from the bank. Suppose someone has started this rumor that SBI is going to fail. Someone has started it and a very credential person has said this in his political debate. This is an assumed scenario. So if suppose there is a very influential political person, he has said that SBI is going to be bankrupt. Now everyone who is having their deposits in the SBI, they'll rush to the ATM in order to withdraw the amount or in order to withdraw their deposits. Now if this happens, then whole SBI system will crumble. Why? Because there are so many withdrawals which are happening and bank may not be able to satisfy all of that withdrawals. Why? Because banks do not keep the total deposits with them. They keep a certain portion in form of cash reserve ratio and statutory liquidity ratio, and rest of all that they lend. So hence funding related risk can arise due to unexpected withdrawals. Next is timing risk. So time risk I have explained you, when you have borrowed for a shorter period of time but you have provided loans for a longer period of time. This is called as time related risk. It is the need to compensate for non-receipt of the unexpected inflows of fund. Your performing assets may turn into non-performing assets. So this is a timing related risk. Next is call risk. Call risk is, it happens due to crystallization of contingent liabilities and unable to undertake profitable business opportunities when desirable. Now call risk is, suppose there was a court case which was pending, or there was a case which was going in the Supreme Court against a bank. Bank has lost it. Now, because of that, unexpected situation can arise and liquidity risk can emerge. So these are the situations where liquidity risk can arise, and you should be able to understand that. Next is interest rate risk. Now, I have in my previous classes see, so your deposit, for all those who are not aware about this particular topic, let me tell you that whatever deposit you make in your banks up to 5 lakh rupees for per person, this particular amount is insured. There is an organization that is called as Deposit Credit Guarantee Corporation of India. So that particular organization provides an insurance kind of thing on the deposits which are made by the depositor. Now please understand this. The question is that why DCGCI is responsible rather than regulator in case of liquidity risk. DCGCI is not responsible. Ultimately, it is your bank who is responsible. DCGCI has been made, this is a statutory organization, that means it has been made by an act of parliament. Why this particular Deposit Credit Guarantee Corporation of India has been made? So that all those people like you and me who are depositing their money in the banks, they should not lose their faith in the banking system. Suppose if someone will tell me that oh, you should not invest in, you should not put your deposits in the bank because banks may fail at any time. This is a viable risk, but I know that my amount which I have given in the bank is insured by whom? DCGCI. So whenever any bank will fail up to 5 lakh rupees per person, the amount is insured. That means I will get back my deposit if it is up to 5 lakhs. So obviously there is a limit up to which insurance have been done. Who bears the cost for it? Banks bear the cost for it. So this is an arrangement which has been made in order to protect the depositors, right? DCGCI is not at all responsible. It is ultimately the failure of regulator if they have not been able to foresee that there is a certain kind of risk which is emerging in the banking sector. So this is the responsibility always lies on the bank as well as the regulator. DCGCI is just what you can say the facility to assure the depositors so that they should not lose their faith in the banking system. I hope you are clear now. Next is interest rate risk. Now tell me, what is interest rate risk? See, okay, the question, I'm going to change the question. Question is, what is the relationship between interest rates and the market prices of securities? What is the relationship between this? Interest rates means your market interest rate, like the government which is paying the interest on their securities, right? The interest rate which has been offered on the similar kind of securities. I have explained you the relationship between interest rate and the prices. So suppose, let's take an example over here. You are a bank, and obviously you are going to invest certain amount in securities. Why? Because you have received deposits. Some part of deposits you have given as loans. This is going to earn you interest, right? You are going to earn income out of it. Some part RBI says please maintain in the cash form in cash reserve ratio. Okay, fine. This is maintained in cash form and obviously I am not going to earn anything on it. And some part RBI says that please maintain in form of mandated securities. called as statutory liquidity ratio. So you also earn interest on it. Now suppose you still have certain ideal funds. So what you are going to do, whether you will provide loans if that is more feasible, or otherwise you are going to invest in the securities. These are the options which you are having, right? As a bank, if I am having money in my hand, these are my options. Now suppose I have invested in the bonds of ABC Limited. Just an example, I have invested in the bonds of ABC Limited, and this particular bond gives me 4% interest. So this is the bond rate. Now what will happen? This investment I have made 2 months earlier. At the present situation, there are bonds of a similar company, let's say DEF Limited, who are giving an effective interest rate of 6%. This is market situation. I'll explain the scenario once again to you, what I'm trying to say. So these are the investments which have been made by me in the bonds of ABC Limited 2 months earlier. After 2 months, I got to know that there is a similar nature of company. That means this company is having similar kind of credit rating, correct? This company is giving 6% interest rate on the bonds. So this is currently going on in the market. Now you people will have to tell me the market price of my investment will increase or decrease. Market price of my investment. One is cost price. Suppose I have purchased it for 150 rupees. I have purchased this particular bonds of ABC Limited for 150 rupees. What will be the market price of my bonds after I got to know about this particular new bond issue? What will happen? Are you clear with the question? If you are clear, then please give me the answer. What will happen to the market price of the bond investment which I have made? Anyone else? Good. Market price of my investment is going to reduce. Why going to reduce? I have explained you this. Whatever investment you have made as a bank, my investment is in ABC Limited. But at the same time, there is a similar company which is giving a more attractive interest rate. This is market interest rate, right? Because of this, people will be less attracted towards ABC Limited's bond, and if I want to sell these particular bonds, then I will have to reduce the price. Obviously, if this pen has got no demand in the market and if I still want to sell this, then I will have to reduce the price and then I will be able to sell this, correct? So in the market, everyone wants the bonds of DEF Limited. Nobody wants the bonds of ABC Limited, but I have the bonds of ABC Limited. So whatever I will have to do, I will have to reduce the prices, and hence there is a direct relationship with the market interest rate and the bond prices. Yes, good, very good. So this is what called as interest rate risk. Interest rate risk means suppose you have made an investment and there has been another investment which has been there in the market that is more attractive. So prices of your investment will decrease. I hope this is clear to everyone. So interest rate risk means it refers to chances that investments in bonds will suffer as the result of unexpected interest rate changes. Now this could also happen, suppose you have purchased Government of India security at 5% interest rate. Suppose. Now after 6 months, Government of India has launched a new security with interest rate of 7%. Why? Because Government of India needs fund. So hence they have increased the interest rate. But because of this interest rate increase, prices of my security which I have purchased have been reduced. Why? Because interest rates are lower in it. Now tell me if you are clear with this concept, or I should be taking another example to explain it. Everyone is allowed to say yes or no. Everyone is allowed to say yes or no. If you have understood it, I will be moving forward. If you have not, then I will explain it further. What about everyone else? Okay. Thank you so much. Let's move forward. So the interest rate is one of the primary drivers of the bonds price. Now the point which you need to understand over here is, I am not talking about the interest rate of my investment, that is static. I am talking about interest rate which is currently prevailing in the market. Correct? So I am not talking about my securities interest rate. The current interest rate, see, the current interest rate and the price of a bond demonstrate an inverse relationship. In other words, when the interest rate increases, the price of the bond decreases. This is associated with the opportunity cost of holding bonds at a fixed rate of interest. How mitigation can happen? By hedging or by diversifying a portfolio. For all those who do not understand what does a portfolio means, portfolio is a basket of different kinds of securities where you can keep different kind of securities. How? Suppose this is a government security. Government security means less returns, but it is a safe investment. You are having bonds of ABC Limited. Here you are getting higher returns, but risk is also higher. So you keep different kinds of securities in order to balance between the risk which you are taking and the reward which you are getting. Fine. Next is market risk. Now let me tell you, in a way, whatever different kinds of risk we are reading, they come under an umbrella term called as market risk. That means liquidity risk can arise due to market situations, right? Interest rate risk, from where it has been arising? Due to market circumstances, right? So all of these kinds of risk, I can term it and club it under a single risk that is called as market risk. So see, market risk is the risk that value of investment will decrease due to changes in the market factors. Now sometimes, very recently, just a day back, there have been a report, there was a news article about Adani Group companies. There is a institution, Bloomberg, or I cannot recall the actual name. Bloomberg, exactly, I guess that is an investigation related firm in the US. They have, yeah, Hindenburg, yeah. So that particular organization, they have done a research on the Adani Group companies, and they have told that many of the companies in the Adani Group are overvalued up to 85%. Correct? So they have said this. As soon as they have said it, Adani Group lost a significant portion of their market cap. Market cap is market capitalization. That means number of shares multiplied by market price of the shares. Why? Because this single declaration or a statement by a reputed organization led to fall in the value price of the Adani Group companies. So this is how, yeah. So this is how your this particular market risk works. These factors will have an impact on the overall performance of the financial markets and can only be reduced by diversification into assets that are not correlated with the market, such as alternative asset classes. Market risk is sometimes called as systematic risk because it relates to factors such as recession that impacts the entire market. Now, if you can recall, there was not recently but sometime back in the Johnson's baby related product, that was found out that it has carcinogenic components, right? So it also led to falling in the market share of your Johnson's and Johnson's, and ultimately they had to come up with an alternative. Yeah, so you people are keeping a tab on it, right? And it is very important also. Such a huge, they obviously everyone is going to say that, as your Adani Group has also responded that a reputed audit firm is doing our audits and nothing of that sort is happening in our companies, but still they have to respond to all those questions in order to come out free. But see, some kind of overvaluation always exists in every kinds of companies. But the problem is it should not be so much overvalued. Now, banks generally invest in products which are related to the prices of commodities, shares and currency movements, and this can lead to market risk. Commodity prices also play a role because a bank may be invested in companies that produce commodities. As the value of commodity changes, so does the value of company and value of investment. Changes in commodity prices are caused by supply and demand shift that are often hard to predict. So to decrease market risk, diversification should be followed. Other ways the banks can reduce their investment, including hedging. Wait for a second. Yeah, so what did we understood till right now is that your market related risk can be decreased, but for that you need to diversify in whatever kind of securities you are investing in, because ultimately you cannot predict that in what kind of commodity or what kind of security you are going to face the risk, right? Next is default or credit risk. Default or credit risk, see, as happened in case of PNB and your Nirav Modi related case, if you are aware of that, what happened in that situation is bank employees, they were involved in issuing a fraud letter of credits, right? And it ultimately led to a huge liability on the bank, and this is a collusion which has happened, and ultimately this is also a kind of credit risk only. It is the risk of loss that may occur from the failure of any party to abide by the terms and conditions of any particular financial contract, principally the failure to make required payments on the loans due to any entity. There are two risks associated with this. One is counterpart risk and the other one is the country risk. The major goal of a project finance firm in the risk management is to ensure that it understands, measures and monitors various risks that arises due to organization and adheres strictly to the policies and procedure. So after analyzing the specific borrower's risk, the credit risk management assigns a credit rating to the borrower. See, every kind of borrower, they can have a risk, and how do we mitigate that? So whenever bank provides any kind of finance to the borrower, the credit history is always checked. What is your credit history? What have been your financial transactions? Were there any kind of defaults which has been done by you, right? If there are any kinds of defaults, then bank will not be able to give you the loan. So every bank has their separate criteria. They analyze the party and then they give. Now this particular default can happen because of the counterparty, obviously, and this particular default can also happen because of the terms and conditions or the loan amount or so many things, right? At the time of COVID, if you remember, many of your MSMEs, that your micro, small and medium enterprises, government has provided them a moratorium on the loans which has been provided to them, so that due to the distress they should not turn into your NPAs. So time to time government also tackles this particular risk, but we do have this default or credit risk in every kinds of banks, public banks as well as the private sector banks. Can you tell me that what kind of banks have, means either public or private, which type of banks have most NPAs? Anyone would like to tell me whether public banks or your private sector banks, which are having the most number of NPAs or the most quantity of NPAs? Even if you don't know, please go and search about it. Next is operational risk. Operational risk is the risk of, this is not inherent in your financial, systematic or market risk. This is the risk which is remaining after financing systematic risk and includes the risk which results from breakdowns in the internal procedures, people and system. Operational losses has mainly three exposures, like people, processes as well as the systems. So suppose, for example, if there is a hacking which happens in the bank's software, then it will be called as the operational risk. Apart from that, I have told you that Nirav Modi and the letter of credit case related thing. Obviously, Nirav Modi has defaulted. So that can be categorized under your default or credit risk from that perspective. But the bank people were involved, means the employees of the bank were involved. Hence, I can call it as a operational risk as well. So every kind of thing has got two perspectives. Nirav Modi case, it has got a default perspective as well, because Nirav Modi has defaulted and he has not been able to upkeep to the what were his commitments. But apart from it, there has been a fraud which was done, and it was done with the collusion of banking sector employees. So hence I will term it as the operational risk. An operational risk can arise because of the three things which are called as the people, processes and the systems. So this is your operating risk. And with this we have completed risk related things. Next will be one more thing. Let me tell you this as well. So there are two subcomponents over here. One is related to transaction risk. Transaction risk is the risk which is arising from fraud. This fraud can happen both internally as well as the externally. Next is compliance risk. Compliance risk means legal or regulatory sanction which has happened. Bank may suffer as account of its failure if it has not complied with all the applicable regulatory laws. So this could happen not because of fraud but due to some negligence, and the above, that is transaction related risk, can happen because a fraud has been made with the bank. Internal fraud means bank's employee were involved. External fraud means bank's employees were not involved but it has been done externally. So these are the things which relation to your risk, and tomorrow we are going to talk about the Basel norms, right? So with this we will end this lecture over here. Thank you so much for joining in, and I hope that you have understood it well.